is India's real estate market concentrated towards tier 1 cities in this reurbanization?
Unfortunately, till the first decade or till 2010, the growth of real estate was largely concentrated around the 4 key metros.
People should buy their own homes and live in them? Or
I think the trend and the data suggests that as India's economic dispersion is happening as a concept, the young generation doesn't want to basically bind themselves to a particular city and a geography. Youngsters would prefer renting versus buying the property by itself.
What should I be looking at to identify whether I'm making a quality real estate investment or not?
The amount of premium that you pay for a quality property is very, very high. You can't go and buy it in a standalone building. You have to buy the great brand, you have to buy the best quality, and for all that, there is a premium. As an investor, if you pay a premium to buy all this, then where is the return? So I think in real estate, investments would move to financialized assets. And I think that's where not just Integrow, but a couple of other platforms are really building that capacity to.
Hey guys, welcome to the 43rd episode of our podcast. As you know, we're here to talk to you about the story of how India is doubling its economy to reach a $7 trillion economy by 2030. One of the major driving factors behind this growth is the real estate sector. And we want you, our viewers, to participate in that growth. And so, in order to facilitate that, we have a really lovely guest with us, Mr. Ramashrya Yadav, an expert real estate investor and the co-founder and CEO of Integrow. Ram, please, I'd love to know a little bit more about your story, and I'm sure the viewers would love to know what your journey through real estate investing has been.
Well, I started my career with construction, then moved into real estate for about 12 years. I led a company in real estate in Mumbai, and then for about 7 years, I led investing in real estate as part of CEO of real estate practice in Edelweiss. And since 2020, which is about 3.5 years, I have been building and managing Integrow Asset Management, which is a true blue real estate investing platform, and currently involved in a couple of AIF schemes and one PMS.
Well, it's really interesting. So you've been a real estate investor for a really long time period. So if you don't mind asking, when did you start your real estate investing journey?
Well, I started it somewhere in 2002.
Oh, wow. So you've seen the Indian real estate market go through several cycles.
Right.
Yeah.
Absolutely.
So I'd love for you to help us, particularly a lot of the viewers of this podcast, they're relatively young. Like myself, we've not really seen, what the journey of real estate investing in India has been like. So what's it been like to be invested in real estate in India? What have been the major market cycles that have, driven asset values up and down? How has it been?
I think if I go back to early 2000, the supply was not there. And between 2000 to 2010, it was all led by the demand. And because the supply was not adequate, the prices just kept on zooming. Between 2010 to 2020, it's been the quality of real estate which has been driving the demand. Mm-hmm. So these are kind of two cycles where in the first decade, we saw that it was the lack of supply which pushed the prices up. In the second decade, it is the quality of demand which is pushing the volume of the real estate.
That's very interesting. So I think you divided it, really beautifully, neatly. But I want to try and talk about two specific incidents. And I'll start with 2008, because in 2008, we saw a global real estate meltdown. And the equity markets also, I think at the bottom, lost almost 50% of their value. So how did the real estate market deal with that?
I think in real estate, what happened during 2006 and 7, it was just the start of equity market play in real estate. Private equity was coming, the markets were booming, the public markets, there were a couple of IPOs which went quite successful. And then there was a 2008, where for about 1.5 to 2 years, the equity markets for real estate were tough. But the demand was so robust that the real estate in India only kept on growing. So the impact of the global meltdown was not very heavily weighed on real estate in India.
Okay. And that's really interesting to know. But I guess there's a second event that's more India specific that I wanted to talk about. In 2017, we had the IL&FS crisis. where a lot of NBFCs that had not managed their assets and liabilities appropriately, and more specifically managed the terms of their assets and liabilities more appropriately, had a meltdown. How did that impact the real estate market?
I think it's not just, the asset liability management. You have to go back to the story behind that. It was November 2016 when the first trigger was the demonetization.
Mm-hmm.
That created a huge liquidity in the market, and NBFCs flushed with liquidity and capital pushed in the growth of real estate. And the second event was the implementation of GST coupled with implementation of RERA. When you have three large changes in the regulation in the economy, the delays are quite imminent.
Mm-hmm.
And I think 2017 was a point, the breaking point, where we were just getting more and more organized, and all these three things are very, very long term.
Mm-hmm.
In short term, because the short term money was getting pushed to the real estate, 1.5 year, 2 year kind of delay pushed everything back.
Mm-hmm.
And that's why that fall. And now again, the real estate, if you see, has been quite consistently growing, both in terms of demand and in terms of supply.
So you've touched on some really interesting topics in demonetization, RERA, and GST. My understanding is that those three events together, they really squeezed a lot of smaller builders out of the market and allowed the real estate industry to consolidate to a few bigger players. Is that true?
It is. If you look at real estate business globally, there is an element of equity, some mezz, and then debt.
Right.
Debt is largely funded like working capital. Indian real estate players have largely been equity starved.
Yeah.
And that was quite at play between 2017 to 2020, where most of the developers who were at a very early stage of their evolution with very low equity had to go out of the market.
Okay.
Because the dependency on either debt or the buyer's equity,
mm-hmm.
both, where the buyer's equity went out because of the lack of trust at that point of time, and the equity was not as supported.
Mm-hmm.
These developers had to go out, and a lot of the professional developers, more institutional developers then emerged.
So that's really interesting. You describe Indian real estate as being equity starved and more dependent on debt. I can see almost some parallels at the highest level with how China's real estate market is unraveled. So would you be able to maybe explain how that's played out to some degree as well? Because it seems like they had a similar problem, if I'm not mistaken.
Not really. I think if you look at the Chinese market, they have the buyers who have gone and backed the newer cities, the newer developments altogether. In India, we are still in a situation that we are not able to augment the demand in the existing cities itself.
Okay.
On top of that, you have not only the new urbanization, but you have the re-urbanization as a big opportunity in India, which is at play. If you look at Mumbai as the key market, for example, more than 80% of the supply is coming out of the re-urbanization.
Yes.
And only 20% is the new urbanization.
So the re-urbanization is redevelopment, if I'm...
Absolutely.
Okay. So I guess that leads me to a sort of interesting question. Is India's real estate market, as you describe it, concentrated towards tier 1 cities in this re-urbanization? Or is there a market even outside, your tier 1, tier 2 cities and the outskirts of cities? And is there a difference in return on investments and capital appreciations that you would expect in, your quote-unquote prime markets versus ancillary markets?
Unfortunately, till the first decade or till 2010, the growth of real estate was largely concentrated around the 4 key metros, and you had a Bangalore and a Hyderabad as emerging IT metro, I would call. But because of the development of infrastructure in last about 15 years, the demand has picked up even the tier 2 and tier 3 cities. And a lot of credit goes to how infrastructure play is happening. And that has led to job creation even in the smaller cities.
Mm-hmm.
So now if you look at the emerging metros, for example, it's in north, it's Lucknow, Amritsar, Indore, Bhopal. And if you come in south, it is Coimbatore, Erode, Mangaluru. These are the newer markets which are getting, or even in west, you have the Ahmedabad, uh, and with GIFT cities growing further. In fact, it's becoming a metro by itself, and then Jaipur. So these are the newer, I would say, the mini metros which are emerging, other than the 4 metros and 2 large markets of Bangalore and Hyderabad.
No, that's very interesting to know. So I guess the crux of this question that I want to try and get to is, over the last 20 years or so in real estate, what kind of returns have investors seen? And looking forward, what kind of returns can investors expect from real estate investments?
I think you have to classify the investors in the way they have habitually invested in real estate. A very prime way of investing in early 2000 was that you go and buy an apartment by yourself.
Yeah.
And you be subjected to the cycle and delays, if there were one.
That's correct.
I think the new age investors are becoming more aware, and rather than betting on to buying the property by itself, which comes with its own set of challenges, tracking the delivery, if you are investing in under construction or post construction, the cost of leasing and managing itself is very high. So the new age investors are choosing different set of financial instruments. REIT is one, which is, let's say, at the mass level. You go one level higher, it is the fractional ownership. You go a little bit higher, you have the alternative investment units. So this is the new wave of investing which has emerged, which ensures that you don't put your risk to an individual project and spread it over a larger portfolio.
That's very interesting. So I'm going to try and go once again on the numbers, because of course that's what people are very interested in. So we've identified, I guess, three instruments for investment. Historically, at least for those 3 instruments, let's call it individual ownership, maybe metros, non-metros, REITs, and then you've got fractionals. How have returns varied?
So let's say we start with in REITs. I think this is for the less riskier assets. Your returns weigh between 9% going up to about 12%, 13% on the higher side, but much safer. Income yielding properties, grade A commercial, listed, and quite liquid. You go one step ahead, the returns are between 12%, 13, 14%, going up to 14%. Bit risk, because it all then depends on the manager, that what kind of properties he is acquiring and how is he managing. So that comes at the play. The third stage is more institutional, where there is a private equity play. There, the returns could be as high as between 15% to 20%. But these are the deals where there is skill at play, there is leverage at play.
And this is only accessible to HNIs or
This
UHNIs.
is accessible to people who can invest above 1 crore as a deal size.
That's correct. Yeah. So looking forward, right? So historically, we've seen great results in the real estate market. I think we're expecting, the economy to double over the next, 6-7 years or so. How will the real estate market evolve?
I think the first 2 decades, and let me count even 23 as end of year, was where you invested in land for high return. You invested in apartments under construction for a return little lower than, and then you invested in commercial for income yielding, which is, in last 3 years, the financialization is a new wave. I think going forward and another 10 years, I would believe that about 70% of investments in real estate would happen indirectly through financial instruments, and 30% investments would happen directly in the property by itself. This is where I see how the market will move towards more democratized financial instruments. As far as returns are concerned, I think the more stable income yielding properties in grade A commercial would yield you between 8 to 10%. One step down, let's say residential, will be somewhere beating the inflation and add another about 400 to 500 basis points. So let's say 8 to 11%. And the new age properties, which is the co-living, the co-working, where there is a higher yield possibility is where you will have higher returns of 11% and upwards.
So it's very interesting. You talked about yield, particularly for co-living and co-working. So am I to understand then that improvements in rental yields on properties is what's going to drive improvements in real estate returns or real estate returns over the next decade?
Right. You're absolutely right.
Okay. So my understanding is that currently the rental yield on real estate properties is about 2.5%. Maybe that's the residential number. I know it's higher for commercial.
Yeah.
Would we expect that to go up?
I think 2 to 2.5% may go up a bit. But when it comes to residential, you have to understand one thing, that equity at play is only 20 to 25%, max 30.
What do you mean equity?
So when you buy a house, you put 30% of your own money,
mm-hmm.
and 70% is what you leverage. The second is, when you leverage that interest cost, if you calculate that and the benefit that you get in tax, your returns and a 2.5%, your returns are actually way above 6%.
Okay. So how does that calculation break down at a high level?
So on a high level, let's say you are buying a property for 1 crore.
Sure.
The amount that you put is 30 lakh.
Yeah.
After 10 years, if you calculate your own equity that you had put on day one and calculate all the taxes, you will easily beat the inflation, even in residential.
Okay.
If it's a good property where improvement has happened. So it's very, I would say, it's very incorrect to say that the total value of a residential property is X and the yield is only 2.5%, because you are calculating on fully paid.
Right.
If you calculate it with leverage, you make a better money in residential.
So just so I understand the calculation, right? On one hand, you have 2.5% on the total property value, but you're paying some interest amount on your loan, and there's some tax offset benefit to that brings that down.
Absolutely.
So when you consider the cash flow in and cash flow out for your rental versus your mortgage payment,
and then incremental value in residential of 7 to 8% year on year.
Okay.
Yeah.
Okay, so that comes out to, the numbers being 6.5%, 7%?
6.5 to
6.5 to 7%.
Yeah.
That's very interesting. Yeah. So we've talked about the financialization of real estate instruments, and I think you mentioned specifically about how AIFs are playing a role in financializing those, real estate investments. I understand that that's what Integrow does, and that's what you guys are offering.
Yeah.
I'd love you to expand on that and how people can invest through Integrow in real estate.
So it's pretty simple. I mean, if you look at AIF, to make it more simpler, there are two ways to look at returns, and based on the profile, that what exactly are you looking at. So the first is that there is an income plus appreciation or plus compounding. So generally the residential investing, because it is self-liquidating, once you invest and the sales happen, the money keeps coming. So we look at, let's say, 8 to 10% kind of a dividend payout, because that money keeps coming. And another about 5 to 6% is what gets compounded over a period of 5 to 6 years. The second one is commercial, where because when we buy the property, we buy it for long and they exit it through REIT. There, the returns are more compounded. You don't look at,
payouts.
Quarter to quarter payouts.
Yeah.
In the first one, there is a little higher tax impact. In the second one, there is a lower tax impact. So that's how you look at investing. And of course, when it comes to liquidity, there is a perception that AIFs are illiquid, but it's not true. AIFs are units in your dematerialized account, demat account, which you can sell at a current NAV. The impact is on your tax, but the liquidity is always there in the market.
Right. That's very interesting. So the big challenge with AIFs is the ticket size is 1 crore.
Yeah.
Why is it not possible to have a mutual fund for real estate investing?
I think as the maturity of the industry increases, as the disclosure norms are followed and done with better, I think REIT in a way is form of a mutual fund, right?
Yeah.
And I don't think that we are far from a situation where there will be mutual funds which would have a hybrid of debt related to real estate and allied industries plus the equity investments.
Right.
I mean, it would be anybody's guess. Will it take 2 years, 3 years time?
Is it a regulatory problem, or is it just nobody's doing this?
I think it's not the regulatory problem. If you want to do mutual fund, you can do, but the amount of paper, the availability of paper is very limited.
Okay, so it's about building supply.
It's about building the supply.
Okay, and how is Integrow building its supply for these quality real estate investments?
So in our strategy, we are doing two things. Number one, we are ensuring that the monitoring-led data is so freely available to the investors that itself creates liquidity.
Okay.
So our first focus over a period of next 3 years is that we need to bring liquidity in the secondary market for AIFs.
Okay.
And once that happens, I think by that time there will be enough amount of supply of paper which will happen, and we can move from AIF to expand to PMS and then to expand to even mutual funds.
Okay.
So that's our journey.
No, that's fantastic. So hopefully, in a couple of years' time, the small retail guys will be able to invest in the Integrow mutual fund for actively managed real estate.
Absolutely.
So I have a couple of questions further, because unfortunately we don't have an Integrow mutual fund just yet, but people are still considering investing in real estate at a personal capacity. So what would your advice be to them, whether they should hold real estate, and if so, how much?
In India, if you look at your own property as real estate invested, and I'm not talking of the high net worth individuals, but generally a normal individual would have close to about 60 to 65% locked in investment in real estate directly or indirectly, and another about 35% in 30 to 35 in other instruments. I think it's a healthy mix. If we leave out Mumbai, which is very expensive for real estate, you almost work 70% of your
Mumbai
life.
Is different. Mumbai is
That's different. But I think keeping a 40 to 50% in stable real estate investment is not a bad idea if you are building a long-term portfolio for yourself.
I see. So I guess to try and extrapolate that, the most pressing question that people have today, you'd advocate then that people should buy their own homes and live in them, or do you advocate that they should use other instruments to hit that 40% allocation, 40-50% allocation that you're describing?
It's very difficult to advocate which way to go, but I can only talk to you about the trend and the data. I think the trend and the data suggests that as India's economic dispersion is happening as a concept, jobs are moving from one city to the other city, and people are becoming more and more mobile as the infrastructure push happens and matures. And the young generation doesn't want to basically bind themselves to a particular city and a geography. And that would mean that a lot of youngsters would prefer renting versus buying the property by self. And that buying the property is what gets replaced to the financialized asset ownership.
I understand, yeah. Okay, that's very interesting. So if I'm an average investor and I'm looking to invest in real estate, whether that's through an individual property or through a financialized asset, what should I be looking at to identify whether I'm making a quality real estate investment or not?
If you are a direct buyer to a real estate, then everything changes, because the amount of premium that you pay for a quality property is very, very high, because that premium is upfront. Say, for example, you want to invest in an apartment. You can't go and buy it in a standalone building. You have to buy it in a larger community. You have to buy the great brand, you have to buy the best quality, and for all that there is a premium. And as an investor, if you pay a premium to buy all this, then where is the return? So I think in real estate, investments would move to financialized assets, and that would need good quality investment managers in real estate who understand real estate as a specialty. And I think that's where not just Integrow, but a couple of other platforms are really building that capacity to, adequately supply that kind of financialized instrument to the new age investors.
So if I'm an investor and I'm looking for a financialized version of real estate to invest in, today, what are my best options and what should I consider when looking at those options?
Today, unfortunately, not many. and it's just the early stage. So maybe if you can afford, you park your money through AIFs. The second level is PMS, or then the third is the REITs and the stocks of the companies, the good companies. So these are the three options. But I don't think we are far from a stage that there'll be schemes and there'll be investment managers who will be bringing more, affordable in terms of size. Fractional is one of them, which SEBI is very, very aggressively working towards a framework for micro and small REITs ranging from 100 crore going up to 400 crores. And I think that would be a reality in a couple of months, and that would be a good option for investors.
That's very interesting. So I think then if I had to take one key takeaway is that our viewers should more closely look at financialized real estate investing, and REITs are coming on the horizon. That's a great investment option.
Absolutely.
For those that can't afford AIFs.
Absolutely.
All right. Well, that's fantastic. And, hopefully we look forward to an Integrow mutual fund for real estate investing in the near future as well.
Absolutely.
Well, thank you so much for joining us on this podcast, Ram. It's a pleasure to speak to you.
Thanks.
And hopefully we'll have you back once you've launched your mutual fund and we can share the stories of success with our viewers once again.
Thank you, Varun, for having me here. It was great conversing with you, and wishing very happy investing to all your viewers and making good profits.
So there's our director's question. We do this sometime. So you have been into real estate market since last 2 or 3 decades. So it's a silly question. You have known a lot of builders in Mumbai. There is Hiranandani, there's Arunwal, there is Raheja, Lodha. These are 4 most famous ones. So being a veteran in this industry and know the building styles and how they construct the properties, which is your favorite builder in Bombay?
That's a very difficult question. I think all 4 names that you have taken are great, but I would consider Hiranandani as one developer who has not built just the buildings. They have built the character of the city by itself. So I really have my respects for Mr. Niranjan Hiranandani.
I was hoping that you will say Hiranandani because I live in Hiranandani. My flat is near Hiranandani, so thank you.
Lovely.
All right. I think that's everything we have today.
Great.
Thank you so
Lovely.
much, Ram. It's a
Lovely.
pleasure to speak to you.
Pleasure.
This podcast is produced by Elixir Equities Private Limited, a SEBI-registered research analyst. Registration number INA 00004787. The information provided in this podcast is for educational and informational purposes only and should not be considered as investment advice. Investment in securities market are subject to market risks. We strongly advise all investors to read all related documents carefully before investing.